Adobe is down almost 50% from the all-time highs placed back in November 2021, where we are at nearly $700 per share. The stock has consistently dropped since then to now lows of $360 per share, as the markets are suffering from a lack of QE and stimulus being pumped into the economy. If you are a current Adobe investor, things don't look amazing, but that doesn't mean that they can't look better in the future. And that is the goal of this video today, to determine whether or not Adobe is a value investment for the future and to determine where Adobe might go from here, if it's approaching a margin of safety now that it's 50% off, or if we should completely disregard this business. Stick around to the end of the video to find out, as we're talking about that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. With that being said, today we're going to take a look at Adobe's Q2 2022 earnings results, where we'll do a deep analysis into the financials. We'll look for any technical setups that actually are setting up. And as you can see, guys, we are down just almost 50% from those highs, which means it's decision time for a lot of investors around the world. And finally, we'll conclude with a valuation of this business to see whether or not this is something we as retail investors should add to our portfolios or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. And again, we are going to stick to the 5-minute rule for the analysis of this video. So let's jump right into it. So first things first, with the technicals here, as you can see, long term, we've seen a great increase in the stock price over time. It's consistently followed this trend higher and higher and higher, and finally it has now broken this trend and now it is downtrending. And this is why I say it's now decision time for Adobe stock and especially shareholders, is because we're breaking key levels of support and what would be resistance as well, right? Because look, we broke here. This is used to hold up as support down here at these levels down here, and now it's holding up as resistance and pushing the stock lower. So where are we going to go? Likely here is the next level of support down near $280, $250 per share, around there. But that is almost $100 away from where the current price of the stock is, actually, yeah, down here at $350 post market. Nevertheless, there's no telling where this might actually go. But in short, as long as we stay below 430, we should see prices lower and towards $250 per share. I do not foresee Adobe getting below $250 per share. But if we do, the next level is down here at 200. So for now, expect this downtrend to continue. Now let's look at the earnings results that they just reported. So revenue came in at about $4.3 billion. That's up 14% year over year. Earnings per share came in at $3.35. We'll come back to these figures later on in the video. And then for their outlook here, they said Q3 guidance is looking like they're going to come just shy of revenue estimates here. And then the same thing for earnings per share. It's going to come in just shy. It's possible that they are sandbagging these results so that they can blow them out of the water later, but we'll see about that 3 months from now. Now, let's look at the financials. Starting with the statements of income here, we have total revenue of $4.3 billion. Of course, they make the bulk of the revenue from subscription services, and they do have some product revenue here as well. And that together sums up this $4.3 billion figure, which we talked about earlier, up 14% year over year. Cost of revenue is peanuts. They barely have any costs on their revenue, which is very good and very strong. And you do have to remember that Adobe is essentially a subscription and service model business, so they're going to have very low costs on their revenues, and that's a very good thing to see, is that they are holding true to that, because there are businesses out there that really do have high costs even though they have a service subscription model, and it eats away at their bottom line profits. So that is good for a potential investment. Gross profit comes in $3.8 billion. Deduct some more expenses, SG&A, etc., and we have about $1.5 billion worth of operating income. We deduct some taxes and whatnot, and we're left with $1.1 billion in net income. There's nothing really wrong with their top or bottom line here. It's just that if you look over at, compare this to, this time 1 year ago, is that we haven't really seen too much growth in the bottom line section here. If we move over to the balance sheet here, we can see that they have cash and cash equivalents here of about $3.3 billion. Nothing else really jumps out to me. And then once we get down here to the debt, we have $500 million there, about $3.6 billion there. So altogether, it's about $4.1 billion of debt on the $3.3 billion of cash. That's pretty good for me. That's good. We know that their debt is serviceable. They have about $8 billion in current assets. So that's good. All right. So jumping into the cash flow statement here, we pull down our net income figure of $1.1 billion, add back in depreciation, amortization, stock-based comp. I don't typically like to do that. So let's give them, let's say $1.5 billion in operating free cash flow instead of the $2 billion that they have on here. What do? They deduct some capex from that, and we're left with, let's say, $1.5 billion of free cash flow to reward shareholders. What are they really doing with that? Yeah, as you can see, guys, right down here, they're just repurchasing stock. So that is their main method of rewarding shareholders. They do not pay a dividend. Their focus is not paying down debt. It is just to reward shareholders through share appreciation. So if we come over here to our summary tab, we can see the metrics we're working with in terms of evaluation. So we have a growth rate of about 15% year over year on their revenues. Then we have a price to free cash flow multiple of about 35 times, which is very high for a business that I would potentially think about investing in. Then we have a free cash flow yield as well of about 3%. So again, that's pretty low. Typically, I'm looking for 10% or more. PE ratio of 36, which is also pretty high. They do not pay a dividend. And then they are buying back shares of about 1% every single year. So with that, let's go into our calculator and make an analysis on this business and see at what price we would be comfortable picking up shares of Adobe for. All right, so taking a look at our calculator here, I actually went ahead and looked at the annual guidance for this year. They said they are probably going to come in about $13.5 in earnings per share. So I just put that into our calculator here, and I just worked up some numbers here. So if we calculate this company with, a required return of about 10%, they don't pay dividends. If we expect the growth rate to continue at about 15% for the next 5 years, then drop down to 10% on a 20 PE, we're looking at a stock price of about $337 per share. Now, if they can actually increase their growth rates to about 20% for the next 5 years, and then 5 to 10 years after that, it drops down to about 13% on a 25 PE, we can see this stock at around 580. And if they do start to struggle from here on, and they only can grow at about 8%, 5% for the subsequent 5 years after that on a 15 PE, we can see them all the way down to 153. All right, so if we look at the stock chart here, we can actually see a visual representation of what we're expecting here. In the best case scenario, yeah, the stock can get back up to these levels up here at, $580 per share. But what we can expect from Adobe is that the stock is going to fall below this level here at 330. And I think Adobe is actually a very interesting investment at this level down here, because anything below here, and we're actually going to be getting some significant value from here, assuming that Adobe can get back to about 15% growth rates on a year-over-year basis. And in the very worst case scenario, where the growth continues to actually decline for Adobe, we can see them all the way down to this $155 price range. This is, of course, worst case scenario, but that would be a decline of, let's say about another 60% from where the stock is right now. So that's obviously doomsday. But yeah, we can expect under this 300 area where we'll actually get some nice value from Adobe, and we'll actually have to revisit once we get down there probably in 3 months time. But that's the analysis for today's video. Thank you for watching if you made it this far. If you liked the video, please give it a thumbs up and subscribe for more of this content. And with that, I'll see you on the next one.